and I'm extremely optimistic about the future. Our company is positioned to grow. We are scaled to grow. We've got over $2 billion of assets. We could scale with really not incremental G&A to over $3.5 billion worth of assets with the staff that we have. I think the tailwinds are at our back.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. I'm pleased to be joined today by Michael Seton, President and CEO of Sila Realty Trust. Sila is a net lease REIT with a strategic focus on investing in the growing healthcare sector, and we're going to focus on its first year as a publicly traded company following the direct listing on the New York Stock Exchange on June 13th, 2024. Michael, great to have you back on the podcast.
Sarah, it's great to be back with you. Thank you for having me today.
So, Michael, let's turn the clock back a year and look at what made a direct listing the right path for Sila and why you were confident in that decision.
When I look back, making the decision as it related to a direct listing, it really made sense, primarily because we wanted to bring liquidity to our existing shareholder base, which was 100% retail. We also saw an opportunity to bring a company to the traded REIT space that was differentiated in terms of strategy. We are the only net lease REIT exclusively investing in healthcare properties. I would also tell you that there was not a lot of capital markets activity at the time. So bringing a company at a time when there's not a lot of activity in the marketplace should bring a lot of visibility. And in fact, that's what it did. So we had a lot of meetings surrounding our listing, both leading up to and after our listing with potential investors in the company. So overall, I would tell you it has been very successful since then, but it was also the right decision at the time, frankly, middle of 2024, when it was certainly difficult to make such a decision. But for what we had done in terms of positioning the company and the size of the company, it was ready to be brought to the traded REIT market.
And in a direct listing, the issuer takes the lead in creating market support for the stock rather than the underwriters leading the IPO. How did you go about that?
Sarah, we decided to pursue the direct listing, I would tell you, primarily because first and foremost, we did not need to raise equity capital. We listed the company at a time when our debt to EBITDA was about 3 times. We typically see for peer type REITs in our space with leverage levels and call it the 5.5 to 7 times. So we were very lowly levered. That allowed us an ability to not raise equity and to create really quite a runway in terms of time, call it 18 to 24 months, to acquire several $100 million of additional assets to further diversify our portfolio. We did ultimately pursue what's called a Dutch tender. And in a Dutch tender, a company essentially sets a price range to buy back its stock and up to a certain portion of it. So we set a price range to buy back up to $50 million of our shares. We set the price range at such a level that was what we believe to be a deep discount to the intrinsic value or NAV of the company, ultimately creating value as we bought back those shares. That share buyback was essentially fully subscribed. It also created a floor on the stock for other investors coming in, so new investors in the institutional space. So pursuing the direct listing made sense, pursuing the Dutch tender made sense, and ultimately what IPOs do to an existing company, the way that they're priced is they create dilution for existing shareholders. We didn't have a need to do it, so we weren't going to do it.
Great. A year later, what does your Wall Street sponsorship look like?
Our ownership at the time of listing was 100% retail. Today, our ownership is majority institutional. So we've had the majority of our retail shareholders trade out of our stock or exit our stock. We wanted to bring the company to the publicly traded market. So should they choose to seek liquidity in their holdings, they could. That, in fact, did happen. Probably a lot of it happened at the time of initial listing. Now our ownership is, as we have been admitted to a number of indices and actually expect to be admitted to the Russell 2000 mid-year this year, a lot of our ownership is by index funds, so call it BlackRock, Vanguard, Fidelity, as well as long-only investors and REIT-dedicated funds. So we've seen a real rotation out of the retail ownership into the institutional space. So the nature of our meetings has changed. They're very constructive meetings that we have. And we are very good about getting in front of our institutional investors, both existing and prospective, to bring visibility to the stock.
And Michael, what would you say makes healthcare REITs so compelling to investors in the current environment?
Well, healthcare is generally viewed by the marketplace to be defensive. Healthcare spending in this country makes up about 18% of US GDP, and it's only expected to grow. It's a large part of the economy, and it's got a very significant tailwind occurring that, of course, we all hear about, which is the baby boomer generation, which is aging. And in fact, come year 2030, the baby boomer generation will all be 65 years older. So the tailwinds are there for healthcare. And those tailwinds ultimately should benefit healthcare real estate. It will benefit healthcare real estate by additional spending for healthcare, which ultimately benefits our tenants, who, of course, pay us rent. These income streams create really the durable income stream that works. We are seeking to achieve in owning real estate and, of course, pay the dividend to our shareholders, which we expect to grow over time.
And Michael, from what I see, Sila has been active on the acquisitions front. Looking ahead, what are your top priorities for growth?
We have been on the acquisition front, very active. We've been seeing high quality opportunities in this marketplace. I would tell you from an acquisition perspective, volumes are not what they were in the kind of 2019, 2021 type timeframe. So overall, the sales market is down. Somebody like us who has a lot of capital available, our leverage is still well below 4 times in terms of debt to EBITDA. We can still acquire several $100 million worth of real estate before we get to kind of the levels that we think we would raise equity. We're focused on really lower cost patient settings, outpatient settings. So examples of those are ambulatory surgery centers, dialysis facilities, inpatient rehab facilities. I would tell you just those settings which are more catering to the patient, more efficient delivery of care, and which are ultimately liked more by insurers because they're environments which tend to have less infection. The turnover of patient volumes can be higher and therefore more efficiencies.
Great. And in an uncertain environment, where are you seeing opportunities today?
We're seeing opportunities really throughout the marketplace, but the opportunities I would just emphasize are very high quality. We're very proud of the portfolio that we've built and the quality of the portfolio, which is over $2 billion worth of real estate. If a seller is trying to bring a product to market today to raise capital or sell a property, it's got to be high quality because capital, generally speaking, in the market is constrained. But because we focus really nationally in acquiring healthcare real estate, with an emphasis, mind you, on the Sunbelt states, because that's where we see a lot of population growth, we are very focused on those areas. But again, focused on population clusters, focused on, of course, the key aspects of real estate that we should be focused on, which are marketplaces, ingress, egress, health system affiliation. So really all the criteria have to check the box in order to make it a viable acquisition for us.
And Michael, as you look back at your first year, what are you most proud of?
I'm most proud of the company we've built. We've built a company to last. We have a great culture at the company. We accomplished something that we had tried to do. The market had been challenging, but we accomplished it in 2024, bringing liquidity to our existing shareholders. I'm very proud of the portfolio that we have. We have 50 people based here in Tampa, and they're very talented folks, and they're really the bedrock of the success of Sila.
Michael, anything else that we haven't covered in our conversation?
I would just tell you, Sarah, that I'm extremely optimistic about the future. Our company is positioned to grow. We are scaled to grow. As I mentioned, we've got over $2 billion of assets. We could scale with really not incremental G&A to over $3.5 billion worth of assets with the staff that we have. I think the tailwinds are at our back, as I mentioned earlier in this conversation. I think the future is bright, frankly.
Excellent. Michael, thanks so much for taking the time.
Thank you, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe or leave a review on your favorite podcast platform.